Hello, I'm Roger Peterson. Welcome to Market Call. Richard Orrell is on the show. He is a portfolio manager at RN Croft Financial Group, and we'll be taking your questions on exchange-traded funds. You can call us toll-free, 1-855-326-6266. Also, send us an email, marketcall@bnnbloomberg.ca. All right, Richard, thanks for joining us today. We're going to talk about a lot of stuff, but we're going to talk about the one thing. SpaceX is officially trading just before noon. It started up, and at one point it hit 163. So Elon Musk was now worth $1 gazillion.
Okay.
He's a gazillionaire.
Yeah.
That's the new term. But it's almost Richie Rich-esque by trillions and things like that. It's hard to comprehend this company. I just wanted your thoughts on it. Just because it's been fun to watch, too.
Yeah, it's a fascinating company, what they do and what the service they provide. Obviously, the valuation is extremely rich at these levels. Coming out as an IPO, super interesting. 135 is the price to investors. Now trading, I guess, see 166.
There you go.
So it's up a little bit. I would say, from our perspective, we're not participating quite yet. So this eventually will trickle into the ETFs. Mm-hmm. It's been fast-tracked into the NASDAQ 100. I understand that. Not yet in the S&P 500. So.
No, the S&P, they stood by their guns, didn't they? And they said, no, come back in a year, talk to us.
Yeah, they'll keep monitoring it, and once it meets the criteria, it'll likely get into that ETF range. And what that does, it provides support for the security, right? Because the more it goes into these ETFs and more into the indices specifically, then the ETFs have to buy to kind of support the stock. I've been on trading floors. I've been around IPOs and the buzz.
Yeah.
This is where the sharks really are, right?
Yeah.
So you have to have a good system, a solid system. It's going to be whipsawing around, that type of thing. You want to be making sure that you know what you're doing if you're getting involved in the security. And I assume we'll start to see all the ETFs follow on. The SpaceX double return, the covered calls with the SpaceX. Those will all follow on within the next few days and weeks.
But it does. I mean, so many people it seems, were hesitant about getting into this. A lot of people, I've heard from a lot of people saying, well, maybe it's still so unproven. Yet so many people are still ready to dive into this. Is it just Elon?
Elon is part of it. I also think there's that fear of missing out, that FOMO, right?
That FOMO.
Money will be made and money will be lost.
But this is a lot of money that you're FOMOing with, though.
Yeah. Well, and if to subscribe to an IPO, you get an allocation if you wanted that 135 price potentially. I heard it was 3.5 to 4 times oversubscribed. Yeah. So a lot of demand.
I think as
there.
high as 5 at one point.
Okay, so that's going to push up the price. But where does it go in the longer run? And like I said, I've spoken to a few clients who want to get involved. I just said, let's just see how it trickles into the ETFs, and we can see the exposure and what we get, and we'll let it be there.
And with the NASDAQ, with ETFs, will it show up on ETFs there?
I'm not exactly sure. Usually they put out a notice saying, hey, it's going in, because they might take someone out if they need to rejuggle the index. So I haven't seen that notice yet. Again, this is also new, Roger. So I'm sure they're eager to put it in for the investor demand, but they have to follow the process.
And then we've got OpenAI and Anthropic coming up as well. Where's all the money coming from for this?
Well, I go back a week. Last Friday
I know we're digressing a little, but it's just fascinating.
No, it is.
Massive. And
there's a lot going on, right?
Yeah.
So I think they raised. I think it was $70 billion, which is the largest raise, right? The company's valued at something like $1.7 trillion at the opening price. Now it's higher, but it's just mind-boggling. It's big numbers, like you say, Roger. And I just hope that investors don't get caught up in it too much, and we get to see how it trades and how it trickles out, and then get into the ETFs.
I'd like to buy one share just to have it.
Oh, you can do it. Probably on your phone right now.
Right now?
Yeah.
Oh, I don't know. I think I'll hold off for now. We'll see what happens. Is there going to be any left? I mean, how many they released?
Well, you can go to the market.
Retailers, I think they released, 30%?
Well, it's trading now, so you can go out and buy it. I mean, if you have a brokerage account hooked up, unlike myself, I have to go through my compliance officer first. You can probably just go and grab it.
All right. We got lots more to talk about, lots more to cover when we come back. Stick around. Richard Orrell is with us, RN Croft Financial Group, taking your questions on exchange-traded funds. Let's get right to the emails and callers. First up is an email from Mike. Subject, I would like your opinion on buying the Sprott Active Gold and Silver Miners ETF, GBUG, instead of passively managed ETFs that follow an index such as GDX or SIL when investing in the precious metals sector.
Okay, Roger. So thanks, Mike, for the question. GBUG, the key word in that description is active. Okay, so there are a number of passive ETFs in the gold and precious metal space, but Sprott's trying to be active. So they're going to add a little bit of additional expense to that because they're doing some extra legwork. It's only been around, I think, since early 2025, so it hasn't had a long track record yet.
Yeah.
So we haven't been able to see whether that active portion is really going to outperform the market. It has since inception, but if you look at the last year, it's lagged a little bit. So if you're dead set on investing in the companies, then GBUG, to me, is an option. You just got to keep monitoring it. Personally, I would wait for a 3 or 5 year track record to see if they are adding that alpha that they're promising.
So if they found their way.
If they found their way, right? They, from the description, they go out, they talk to companies. I mean, they have that angle as opposed to passive, but it's that age-old kind of approach. Am I going to go completely passive, or am I going to go active? Because a lot of active managers don't end up beating the index benchmark out there. That's
really? Okay.
Yeah. Not everyone who just because you're active doesn't mean
you know what you're doing.
Not necessarily, right? Or the periods where there's bad underperformance. So, and then maybe not Mike's question, but also you got to separate. Do you want to be involved in the companies, or do you want to be involved in the outright metals, right? So you can also just play gold or silver by itself. That's where I tend to play more, because I don't want to deal with things like jurisdictions and some of these countries' mines can just disappear.
Yeah, once you know it's out of the ground, it's out of the ground.
Exactly. Yeah.
All right. Let's get to the phones, and Patrick from Halifax.
Hi. I want to ask your guest about the Harvest Diversified High Income Share ETF, HHIS. I'm a senior and I'm using this for income, and I know that this is a kind of vehicle mostly for income, not much for growth, because it's actually down a little over 9% since its inception. And I want to ask what percentage of a senior's non-registered account should one hold this particular fund, and that would be considered safe for us? Thank you.
All right. Thank you, Patrick.
All right, so Roger, pretty specific question. Usually when I'm recommending weights to clients, we're talking, for hours, right?
Yeah.
Before I get to the conclusion.
We don't have hours.
We don't have hours.
We got,
that's good.
We got how much we
That's
have
good.
left? We got 46 minutes.
Especially
minutes left.
When does Team Canada kick off? That's the other question.
3 o'clock.
Okay,
so we got
perfect.
time.
We got time. So Patrick, I can't make a perfect recommendation for his circumstances, but you're right. And these ETFs often have that distribution. So the distribution is probably about 9%. They usually try to keep the net asset value or the NAV fairly stable and pay that distribution. So you got to watch on that distribution how much are they returning in capital, how much is dividend, and how much might be option income. I'm assuming it's an option strategy in there as well. Okay, so it lies in a portfolio somewhere between your equity and your fixed income, right in that middle sleeve. So you can kind of dip into maybe, if you wanted to hold 10%, you dip in 5 from your equity and 5 from your fixed income and say, okay, I'm going to hold this as a bit of a higher approach, but recognize that if markets start to come down, this will also come down along with it.
Okay. Let's get some more callers in. We've got a few lined up here. Nizar from Scarborough, Ontario. What's your question? Hello, Nizar.
May I have your thoughts on XEQT, iShares Core Equity ETF? It has exposure to international, Canadian, and U.S. equities. It has a dividend of 66 cents quarterly and a low MER of 0.20%. I'm looking for income and some growth. Would you recommend this for someone like myself? Thank you for taking my call.
All right, Nizar, thank you.
So the iShares, this is all equity portfolio, Roger. So this is really where ETFs kind of excel if you really just want to set it and forget it.
Yeah.
But this is a fully equity exposure. So when the caller Nizar mentioned income, to me, this wouldn't really be that side of the portfolio. It's more for longer term growth, which can work out well depending on your time horizon. But these ETFs are really structured kind of more for a set it and forget it. I just want equity exposure. Leave it alone. I'm going to let the markets do what they want to do and not try to get into some more tactical approach.
All right. And if he's looking more for income, what?
In the income, if we want to increase the income but still have the growth side, then you've got to start looking at some of the equity income. We want to try to get the dividend yield more up to about 3 or 4% if you can, to kind of, you'll give up some growth, but you get more of that income coming off the portfolio.
Okay. We're going to get back to the phones, and Richard is calling from Rossland. Richard.
Good morning, gentlemen.
Good morning.
I'm interested in increasing my oil exposure in my RIF with a Canadian ETF, hopefully for long-term hold. What would you recommend?
I'll turn to you for that because I'm not going to recommend anything.
No? Okay, Roger. So
it's on you.
There are two two choices that I would recommend. So if you want to go for more of a straight, I just want to have the oil exposure.
Yeah.
Now we'll see. Obviously, Trump promised that the tax are over in Iran for maybe, 7th or 8th time last night? I'm not sure.
I heard somebody say that it was the 22nd time.
22nd time?
Yeah.
Okay.
I don't quote me on that, but somebody had said that was the number they heard.
I don't have a Truth Social account, so
Yeah,
maybe
yeah.
that's why I'm missing them. But we have used, so the two approaches, one is XEG, so just the oil ETF for Canada, and the other one is the ENCC, which is a covered call approach. So it's going to help, it's going to cap upside, but it's going to help dampen some of the volatility and give a bit more income. So depending on what the caller, Richard, what he wants to do, if he just wants to go for outright growth, go for the XEG, and if he wants to maybe have a bit more of a risk-adjusted approach with a bit more income, I would go with the ENCC.
And could you bring the two? Can you buy a little bit of both?
You could, yeah.
Is that a good move or?
Yeah. Well, I didn't get into it in the top, but I was going to talk about how many ETFs there are in Canada and how there's more and more every month. 44 new ones last month.
Well, let's talk about it a little bit right now. Here
Right. Sure. So you just have to see what overlap you have, or maybe what because you're dealing with oil companies.
Yeah.
But do you want to have certain ones, and what do the weights look like? Like I'm sure CNQ's in there. Both of them fairly large. Canadian Natural. So you just want to make sure that it meets your criteria. You might want to go down into some more of the mid caps or maybe some small cap energy. So just have to see how they blend together.
And how many ETFs are there out there now? Are out there now? Easy for me to say.
I think we are approaching almost 2,000 ETFs.
2,000.
2,000, yeah.
And to try and weed through those.
Well, that's the idea, right? There's more and more coming. A lot of the major institutions are finding investors are demanding that some of their mutual funds move over.
Yeah.
Everyone's aware of fees. Everyone's aware of costs, which is great. It's better for investors, but it also could make the problem of, we have as portfolio managers, we have two main things. Know your product. So we've got to know all these things, and also suitability for the client. So it just makes that job, kind of escalate even more and more as these ETFs come out.
All right, we're going to take a break, but we'll be back with Richard Orrell of RN Croft Financial Group taking your questions on exchange-traded funds. All right, welcome back, and let's get right to the phone lines. And first up is Elliot from Hamilton. Elliot.
Good afternoon, gentlemen. I'm strongly encouraging a 38-year-old relative who admits to knowing nothing about financial markets to start getting invested. And I'm thinking a good foundation might be something like BMO's growth ETF, ZGRO, a fund of funds that covers all the bases. What do you think about this as a foundation for a future portfolio? And would you know what the MER is? Thank you.
All right, I think Elliot has good seats for the soccer game already, doesn't it? It sounds like he's got his seats at the bar already.
Yeah,
okay.
Yeah, maybe. So thanks for the question, Elliot. So you gave me one piece of information. I don't know a whole lot, but 38 years old. So to me, that suggests the time horizon is fairly long. Again, so ZGRO, just so we know what it is, it's the BMO growth portfolio. And these, all of the providers have these basket of ETFs that hit a target asset allocation. And this one is 20% fixed income and 80% equity. So the 20% fixed income will hopefully dampen some of the volatility, but you still got a lot of growth there.
Yeah.
And So 38 years old, if it's for the long term, yeah, it's a good starting building block for a portfolio. But if it's a shorter timeline, if it's, hey, I need to buy a house or something like that, then that's not a good option, right? So you got to really make sure that you're hitting the right ETF for the right objective.
Yeah, you need more questions.
Yeah, you need more questions. I do know that these things tend to have a fairly low MER. I know the Vanguard ones, which I use in some of my smaller portfolios, are around 22, 24 basis points. So pretty good value for what you're getting, because they're doing all the rebalancing for you. You're just putting money in, and they're keeping the portfolio in line for you.
Okay, we got lots of callers to get to. Elliot, thank you for that one. Chris from Delta, BC, what's going on?
Oh, Roger, when I realized you were the host, I had to call in and just say how much I enjoy hearing your remarks in that hour before market call starts. So thank you so much.
I hope I don't get in trouble for some of them. Thanks for watching, though, Chris.
No, it's a pleasure. It's a calming reassurance before the volatility picks up in the day. I'd love to hear the guest's opinion on SHLD and the defense sector in general. I've sort of gone the way by expressing that in just RTX, but I'm wondering what the guest thinks about diversifying into a defense ETF. I'll hang up and listen. Thank you, gentlemen. Have a great day.
All right. Thanks very much, Chris.
Thanks, Chris, for the question. So, Roger, we do actually own some SHLD for some clients in portfolios. Again, it's on the defense side, so it's a mixture of defense companies. I think, we've had lots of conflicts. We'll see how those conflicts evolve. We spoke about Trump and Iran. Obviously, Russia and Ukraine are still, at it. So I think, just zooming out, again, I'm not a policy expert, but just the way it's changed, we've seen so many drones come in, right? When we saw the Iran war start, Iran is sending drones, and the U.S. is shooting them down with $1 million missiles. Yeah. That just doesn't, the economics of that doesn't make sense in the long run. So I'm sure
$30,000 drones, $1 million missiles, take them down.
Exactly. So I think it's evolving. That's why I actually prefer ETFs for this space, because I don't know necessarily who's going to be the winning company. I can have some inkling of who might win, but the caller mentioned they're involved in RTX, which I believe is Raytheon. And so if you have the ETF, it might not matter which one is the winner, or which one finds better device or can block a jam, or all these nuances of that I know nothing about. Yeah. But you're probably going to have the winner, and the sector
in there somewhere.
Will move. Some clients have issues with investing in the defense sector, but for the most part, if you're looking for a good ETF in the defense area, SHLD is a good one.
And has the defense sector overall, has it moved as much as people were expecting it when everything started to flare up?
Well, it actually moved a lot before, and now it's starting to kind of, I believe, trickle back. These conflicts are going to probably continue in some way or another, and defense spending is going up as well, right? So all the NATO members have to get to 5% of GDP. Yeah. So we know, and this ties into the aerospace as well, so MDA space. And unfortunately, we don't have many in Canada, but we'd actually almost prefer if there was a Canadian-focused defense, because we think there's a potential there.
There's enough there.
Yeah, for a lot of these companies to come along in Canada and build made-in-Canada solutions to grab some of those dollars that the government's
maybe they'll start up with that money the government is offering.
Maybe ETF number 2001 will be...
Not another one.
Yeah.
Okay, Dave from Ottawa, what is your question?
Hi, good afternoon, gentlemen. I'm in a bit of a gambling mood, and I'm feeling like investing in a Bitcoin ETF, like CI Galaxy Bitcoin ETF. I think it's Canadian hedged. But before I do, I'm kind of curious, what exactly will they invest my money in? Is it in some sort of index, or is it actually in the coins, or what? Wonder if your guest could help me with this. Thanks. Bye.
All right, Dave, thank you. Richard, what do you say?
Yeah, Dave, so this is a perfect example, right? Know what you own. So you can usually go online and check and do some research about the ETF and find out what they hold. Now, I don't know this one in particular, but most of them hold actual Bitcoin. Okay, so they've got either a wallet, cold. There's a lot to it.
And they have a strong stomach too, right?
Yes, lots of volatility here. Bitcoin has certainly been, we haven't held Bitcoin for a few months now. We trade this more than anything else because, again, it's kind of it's almost like a gold, right? It doesn't really it doesn't give you a dividend. It doesn't, it's a store of value. It's kind of an inflation hedge, these types of traits of it. But yeah, you can see there, it doesn't look very good from a chart perspective either.
Yeah.
So I think my approach would be to kind of see, okay, we've got SpaceX, because if you're feeling a gambling mood, you can just go with SpaceX. But you also have Anthropic and OpenAI coming out. I think we have to see those dollars shuffle around too. And then Bitcoin, maybe in the latter half of the year, might see some, what about Bitcoin? Where did it go? And might see some dollars come back to it.
Okay. All right. Well, we're going to head into a break right now, but when we return, we'll take a look at Richard's past picks. That's next. And you can reach us, of course, at 1-855-326-6266. Also, email us, market call at bnnbloomberg.ca. Time now for Past Picks with Richard Orrell, Portfolio Manager, RN Croft Financial Group. Richard, thank you for being so patient with me. This is hour 4 today, and it's Friday. Let's take a look at your past picks. And first up, the Invesco NASDAQ 100 Index ETF, QQC.F. Did I say that right?
Yeah.
Okay,
you got it right.
Yeah. I haven't done this in a while. I'm rusty.
Not bad for hour 4.
Okay, how are we looking? How's it looking here? 26% return.
Yeah, so this is just the NASDAQ 100 index ETF. And then most of the time when you see the .F at the end, it means it's Canadian dollar hedged. So when I build my portfolios, I kind of use a mixture of unhedged and hedged, again, just to try to flatten out some of the volatility on the currency. It's done well, obviously. It's pulled back with the market correction. And I guess this is where I'll be looking to see when SpaceX pops up into this ETF. I plan to continue to hold it for clients. It's in my model. It's a core holding. It's fairly reasonably priced, a very benign ETF, and if you want that growth and exposure, this would be where I would stay.
Solid, is that the word we can use for it?
We could use solid, yeah.
Okay, then next up, we have Global X Artificial Intelligence Semiconductor Index ETF, CHPS on the TSX, California Highway Patrol.
California.
It's long. It's Friday. It's the end of the long day, and I'm on vacation after this. They're not going to get any better, the jokes. Okay, let's talk about it. How did it do? Look at that.
Yeah, so this has been on basically just the AI build out, right?
Okay.
So we've seen
which has been on fire.
It's been on fire. This is a fairly concentrated ETF, but the names, the biggest names in there. Again, this is I had this only for some extreme growth clients. Still have it between this and there's one called SMH and trades in the US Semiconductor Index as well. Looks very similar. I still think the AI story is alive and well, but you're going to get the volatility.
Yeah.
That's the price you pay.
Which we've seen over the last little while.
Yeah, but that's the price you pay, right?
Yeah.
If you want to have returns like that, you have to kind of sit through some of the volatility. Now, you look at that chart and you look back and, it's an easy ride. But, going through that day to day and week to week, it's not always easy to kind of stay involved. But I still like the story and still hold it for some clients.
Are you still feeling, not worried about people rotating out or because it went up, then it seemed to flatline for a bit. Now it's soared again. Are we?
Yeah, Roger. So I have to admit I'm a bit of a nerd. I went to University of Waterloo. I still have a desktop computer. Okay.
Aww.
And actually got a blue screen of death the other day. Okay. So I did some diagnostics, and my RAM is bad. So the little memory sticks. Okay?
Yeah.
And so I went to go look at the prices. 2 years ago, I could have bought a couple of memory sticks for $150.
Yeah.
Those same memory sticks, maybe slightly faster, but still work with my computer, they're $600 now.
Holy.
So that's all margin. I don't think the technology necessarily changed, but that's all margin expansion. That's why all these companies have gone,
Meteoric almost.
Meteoric. And it's cyclical. Can it get ahead of itself? For sure. But, the backlogs, the build out, you hear Oracle, they've got a huge backlog. They can't build data centers fast enough. They can't get enough of these chips active right now. I think that still continues. Eventually the music stops, but it's not, for me, it's not for the next 12 to 18 months.
Okay, let's get the last one in here. iShares Core S&P 500 Index ETF, Canadian Hedged XSP on the TSX, 15%.
Right,
sorry, total return 16%.
Yeah, so this one is the S&P 500. So this one, I guess, will take a little longer to have the soup du jour, SpaceX, right? But again, it's just S&P 500. It's a core holding for many of our clients across all of Croft's models. And it just gives us market performance. And when you get dips, you buy, and over time it tends to go 9 to 10% as long as you can handle the volatility. But it's a bit lower volatility than, say, the chips or the QQC.F.
Yeah, the S&P is a little more of a stable delivery, right?
Yeah.
For it?
Yeah.
Okay, we'll wrap it up on that note. For now, we've got lots more coming up with Richard Orrell of RN Croft Financial Group. He'll be taking your questions on exchange-traded funds. All right, let's get right back to the calls and emails. And this email is from Brian. Could I please get your opinion on the Roundhill Memory ETF, DRAM?
All right, Roger. So as I was diagnosing my computer,
A DRAM?
A DRAM, yeah.
Is
So
it DRAM or DRAM? I go for the Scottish side, a little wee DRAM.
Fair enough. I'm with you on that one.
Okay.
We'll go with that. This is getting pretty thin slice of the AI trade. So again, and these companies have done really well. I think Micron would be in there, SK and Hynix, and Samsung. So these are the big producers of it. Two of them are actually located in South Korea. And if you
They've
want to
had
see,
very good years so far.
yeah, and if you want to see concentrated markets, look at South Korea. Those two make up 46% of the index. Anyways.
And that market is, and that index has doubled, I think, this year, hasn't it?
Yeah. So there's a good theme here. I just, when you get these big numbers and you're not diversified out enough, then you got to be very careful. So I wouldn't be jumping in. I see this more as a trading vehicle, especially because it's a bit narrow. When you're starting to get to more of the AI or even chips, you get into some of the chips designers and other sides of it. But these guys are just only doing this. So you've got to, and it is cyclical. It's gonna move up and down. So I wouldn't personally use it as a sleeve in my portfolios. It's not quite big enough from a theme. But if the caller, I don't see anything wrong with the ETF from a structural point of view or from a fee point of view. It's just not something I would use.
Okay, but you say you keep it as a trading
vehicle.
So
right?
what does that mean for then?
So for me, it's more of a short term, right?
Yeah,
so
okay.
I'd be looking more for technicals, overbought, oversold, those types of conditions to get involved. And again, I've been through this business. I've worn many different hats. That's not a hat that I would want to wear as much anymore, because you'd like to think you're right all the time, but I know that I'm not right all the time.
Yeah. Okay, let's get back to the phones. And Andy from St. John's, Newfoundland. Andy, how are you?
Hi, thanks for taking my call. My question is on XQQ. Now, I don't own any ETFs, so I'm just trying to play around here, trying to find some good ones to go into. If you can suggest a couple, or what do you think of this one?
All right.
Okay, so Andy,
you got free reign here.
Yeah, XQQ is very similar to my QQC.F that we just spoke about in the past picks. It's nearly identical. So again, what are you getting here? So you got to know what you own. You're getting the NASDAQ. So if you're willing to let that money work for 5-10 years, you're probably going to be okay.
Yeah.
But you're going to have to deal with the bumps.
Along the way.
Along the way. Of
course.
And SpaceX is going to go in there, and other companies are going to be in there. That chart doesn't quite look right. Something's happened there. But
it's quite off a cliff, isn't it?
Yeah, that's not quite right. But anyways, the idea is that you're investing in NASDAQ. You believe in technology in the long run, and
there
you're
you go. How's that?
Yeah, the 1 year looks much more appropriate.
Okay.
So again, it's all about objective, goal, time horizon.
Yeah.
And so XQQ is fine if it's a longer term growth objective.
All right. So you really got to sit down and put a plan together and then start looking, right? Sounds like the base.
Yeah. I mean, not everyone gets everything, right? Because I could always go, like I always say to people, I can get the most return, but you won't be able to sleep at night. So, I got to make sure you got to balance this out, right?
Yeah.
And in some cases, there are clients that don't even need to take that risk because they've accumulated wealth through other means and they don't need to take that risk.
Yeah,
and so that's just a conversation. Or they have other plans. Hey, this is for my kids. Yeah. Okay, that's where we can put a little bit more.
Set it aside and away you go.
Exactly. Yeah.
All right. Let's get an email in now. And it's from Peter. It says, looking to balance dividend income and growth through the Canadian market settled on XEI and CDZ from iShares, which is best? And if there's a market downturn, how will they fare? If oil prices fall, will one be more affected? Lots of questions.
Peter,
Richard, we need lots of answers.
Yeah, very. Thanks, Roger, for to get me going here. So I did take a look at this one, and I would settle on the XEI. Okay, you can see there the comparison. It's done a little bit better from performance. The volatility is relatively similar. Now, there's just a nuance in the strategy. So if you look at the names, the Dividend Aristocrats, which is the CDZ or the orange line on the screen there, is that looks at companies that are increasing their dividends, but they might only have a 0.5% dividend. So yeah, they're still increasing it, but it's not a big driver.
And when they say it goes up 20% from 0.5, it's not much.
It's not much. So, and whereas the XEI focuses more on higher dividend payers that historically have also kept their dividend, but you can think, like companies like CNQ, the banks are in there. I mean, they're in both, but just the weights and how they're constructed. So it's very nuanced, this. They're both okay, but I would definitely go with the XEI over the CDZ. The fees a little bit lower, and just some of the traits I like better. As far as, and again, I think just to make sure we cover all the questions here, oil prices fall, they're both going to be impacted. But again, you can look at the weights of that sector in each ETF and decide how much oil you want in your portfolio.
Okay. We're going to take a break right now, but we'll be back with Richard Orrell of RN Croft Financial Group taking your questions on exchange-traded funds. All right, let's get back to the phones. Paul from Oakville, you're up. What's going on?
Well, I wanted to ask if there's a possible ETF involving space technologies. This week we had a Canadian company launch, I think, 1 or 2 rockets off the east coast of Canada. And today we have a massive SpaceX IPO being launched at the NASDAQ. So do we have any Canadian companies or Canadian-U.S. involving such similar technologies in an ETF?
All right. We'll let Richard answer that. Paul, thank you for that call. It was in Nova Scotia. They launched a couple of rockets. So
yeah.
What options do we have?
So space tech, there are a few. There are
This
a few
would be
tickers.
Space A, wouldn't it?
Roger, that one's over my head. But yeah. There are a number of ETFs in the space area. If the caller wants to get involved in, one that comes to mind, I'll give you a ticker, is NASA.
Okay.
What's that?
NASA. It took me a second. When you spell it out, you don't think about what it actually says.
NASA. Now, what's interesting about this ETF is it actually held a bit of SpaceX prior to the IPO. So it's really been moving. Again, these things are going to be very volatile. A lot of funds going. I don't know exactly today what's going on because you could see these ETFs sell off as people can flood into the actual SpaceX vehicle itself. Because I read that SpaceX delivers about 85% of the tonnage to space. It's currently. So
they're about the only game in town right now. And they want to get it
cost.
up. I think they're going to be launching a rocket every 2 hours. Is his goal by 2030 or something like that?
Yeah, and the cost per ton is lower than anybody else by far. So they have a huge advantage. So that would be my pick, is the NASA. Again, it's speculative. You got to be prepared for some ups and downs. But if you want to hold ups and downs, if you want to hold it for the longer term, 5-10 years, that's where you could go.
All right, we're just looking at SpaceX right now, 166. So it's up.
Trading fairly quietly, actually. It's
where's it? Now we're both very quiet, just watching.
Yeah. Look at that.
Look at that number go. All right, let's get another email, Richard. This is from Sandy. I'm looking for a U.S. dollar fixed income ETF. Does the guest have any ETFs that he likes? I'm sure you have a lot you like.
Yeah. So Sandy, I'm going to make an assumption here that you still want to hold this in U.S. dollars, okay? Which a lot of people still have a few U.S. dollars kicking around. I'd say in some ways, we've gotten almost anti-America too much. We got to still keep U.S. companies in our portfolios. They're still driving the economy. But Canadians, I guess, I know why, and I feel it too.
I know, but business is business, though.
Yeah,
right?
To some extent, yeah. And so the assumption I would be is that you want to get exposure to U.S. dollar. Now, the nice thing about having U.S. dollar is that if you look at interest rates and where they are, it's still higher in the U.S. So you can get on some of these interest-bearing U.S. ETFs in short-term treasury bills and things like that, 4% versus 2% here in Canada, and that's appealing.
And I guess if you look at it as Canadian, it's like 6%, really, right? Isn't it? I just got weird math there, but you know what I mean? With the exchange
you're testing
and all
my math.
that.
Yeah. Well, you got to watch the currency. You got to watch the currency for sure. So my pick would be ubill.u because you're getting the exposure to the U.S. rates, and the .u, Roger, on most of the ETFs means it's trading in U.S. dollars. So anytime you see a ticker at the end with a .u, it's U.S. dollars. I've looked fairly long and hard for someone who's doing exactly that, which is trading a U.S. and then converting it to Canadian and hedging it. But I just haven't come across one yet, even though despite the 2,000 ETFs out there.
Okay, 2001. Next email is from David. Your thoughts on XLV? I've been looking at it to balance out my portfolio.
Okay, so actually this is another piece that you'll see, I guess, once the email goes out. I actually do call out this sector. I actually like healthcare for a little bit of short-term alpha here, along with the financials in the U.S. I think there will be some trickle over to the AI. There's been a few problems with health insurers. You never know what Trump's going to do, who he's going to hit on next, basically. But he's already kind of done healthcare. I think maybe that's getting past that. And then you've got just the juggernaut with the GLP-1s, Eli Lilly's
so still no signs of that slowing up. Eh?
Yeah. So I think that's why I kind of like that space. Again, I'd be looking to pick this up and trade it as a sector. But I do like the XLV going forward.
Okay. On that. And actually, so we're going to another email here. This one's from Dustin. Could I get your guest's opinion on VEQT as a long-term hold for capital gain in a corporate investment account?
Okay, so we're getting pretty specific on the tax lens there, the corporate investment account.
Testing you.
Yeah, VEQT, very similar to the previous question about XEQT. So growth-oriented completely. Definitely can be applicable to a corporate account. There are some other vehicles out there that even defer the distributions as well. So it depends on what you're trying to do in your corporation. A lot of people just don't want anything coming off because there are some rules around that. Again, a bit past, but from what I know, but always consult your tax person.
Yeah.
But given what the question says, it is a fairly appropriate solution for long-term growth in a corporate account.
Okay. We'll leave it on that note there. We're going to take a quick break. When we come back, we'll take a look at Richard's new top picks. Joining us Monday on Market Call, Gordon Reid will be on the show, President and CEO of Good Reid Investment Counsel. He'll be taking your questions on U.S. equities. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. All right, time now for top picks with Richard Orrell. And first up, BMO USA High Quality ETF, ZU, I guess for the USA, ZUQ, TSX. Tell us about it. What are you liking about it?
Yeah, so it's an ETF that has a couple screens, and so it just screens for a factor called the quality, I guess high quality factor. And what that does is it just screens the companies for a high return on equity, stable year-over-year earnings growth, as well as low financial leverage. So you get some really quality companies. It's on the MSCI USA index, which has a few more members than the S&P 500, but you end up with Apple, NVIDIA, Eli Lilly, Meta, Visa as some of the higher holdings in it. And I really like those companies. There was a while ago, Roger, when I used to actually have individual stocks in client portfolios, and Apple, Google, Microsoft, Visa, MasterCard were kind of my go-to picks.
Yeah.
So this way I can roll it into an ETF. It does some filtering. And the other thing I like about this ETF is it comes down into a few mid-cap names as well. So you get a good basket. It's a strong basket. It's resilient. You can even see recently it's hardly ticked down. Last Friday was a pretty heavy hit to technology, but this basket didn't really even move down that much because those companies are just resilient and strong.
All right, and I'm just looking. Eli Lilly's a notable overweight in it. Good, bad.
I like
okay
it.
with it.
I like it.
You mentioned before.
I think that story goes on. I mean, I'm not an expert in drugs, but I think GLP is seems to have lots of promises. They keep finding
new things. I think is the big thing.
New things keep coming out. Some side effects. I mean, there's going to be stories about that too, unfortunately. But I think the net benefit is going to be higher than the net negative. And so, and it's showing financial resilience, and it's good companies. So these things rebalance either semi-annually or quarterly, and they keep shifting a little bit. And so I really like this approach over the long run.
Okay, next up, the Invesco S&P 500 GARP ETF, SPGP, NYSERCA? NYSEARCA?
Yeah, so it's listed in the U.S. on ARCA, the stock exchange.
Oh, oh my God.
Yeah, but it's okay. What the GARP stands for is growth at a reasonable price. Okay, so not GARP, but I know where you're going, Roger.
No.
But
I'm going home hopefully soon.
Yeah. What I like about this ETF is that we've seen a big increase in some of the larger caps, and I think there's merit in those ones as well, because I pair it with other of those. But I also like to see at some point valuations are going to matter again, right? As they stretch, and I know earnings are great. Earnings are growing spectacularly, and projections are for earnings, but they're projections. But when you get companies that really lock in and really just keep compounding and growing at a reasonable valuation, eventually that's going to swing back in your favor. So this is more of a reversion to the mean trade. Okay, as those stocks get up, and you can narrow that gap in between the other ones. And so I'm playing it with this SGP. I've held it before. I don't hold it currently. I have a bit personally, but I do like the strategy just given what's going on in the markets right now.
Okay, last one, we're looking at the Global X Active Canadian Municipal Bond ETF, HMP on the TSX.
All right, so this one is pretty sleepy. Okay, it's on the fixed income side.
But that's not a bad thing. You need balance, right?
You need balance in your portfolio. And why I this one came on my radar, and why I like this one is the municipal bond space is very fragmented. So it's a good place where you can use an ETF structure, have it managed by Global X. They have an active approach in there too, which they've done very well on. And they can take care of that for you. So for you and I, I mean, I could do it, but for the average investor to go and say, hey, I want $5,000 off as a municipal bond, you're not going to get good pricing. But for these ETFs, they can go and say,
hey, in bulk, right?
They're buying in bulk. So they're buying more. They're going to get a better price. They're going to monitor it, and they're going to make sure it's okay. So what do you get to the investor? You get a little bit more yield because you're moving out. Okay, you got you got Canadian government at 2%. Municipal bonds are about 3 and a little bit. So you're taking a bit of credit risk, but you're getting a bit higher return. For some of our very conservative clients, we've just taken a position in this ETF.
Okay, but if you may get a larger yield because they're buying in bulk, are you paying more management fees on those ones too, or is it?
There is a slightly higher fee. I think it's about 2.9. 0.29. That's a big difference. 2.9 would not be good. 0.29%. Yes, but I'm okay. Again, I'm paying for them to add value in that space, and I believe 9 out of 10 years they've actually beat their tracking index, despite the management fee. So it's not for everybody, but if you're looking to stretch for yield a little bit and you want to put something a little bit different in your portfolio and still have a fairly high credit rating, 5%, something like that. This could be something for an income conservative investor to look at.
Richard, we got to wrap it up there. Thank you as always for joining us and tolerating me today. I appreciate it. Thank you, sir.
Yeah, take care.
Richard Orrell, Portfolio Manager, RN Croft Financial Group. Thank you for joining us. That's it for Market Call. We'll see you next time. Have yourself a great weekend.